Okay, so in this presentation, we're going to go through several examples on the Chapter 2 material in hopes that by the end of this presentation, you will have plenty of knowledge to be able to get through the Chapter 2 homework. Okay, so in our first example here, we're going to look at analyzing account entries and balances. So it says to use the following information in each of the following separate cases. So we have parts A, B, and C, and we'll look at each of those individually on the slides to come. Okay, so in part A, they're asking us to compute how much cash was paid on accounts payable during the month of October. So Florentine had 152,000 of accounts payable to start on September 30th, and they had 132,500 on October 31st. Total purchases were $281,000, and we're asked to determine how much cash was paid on the accounts payable during the month of October. So if we create our T account to analyze all of our transactions, they tell us that the starting balance in accounts payable was $152,000. So this $152,000, if we're talking about accounts payable, what type of an account is that? It's a liability, right? And so liabilities have a normal balance of a debit or a credit. A credit, right? So let's put our starting balance on the right side because that's the credit side of the T account. And then they tell us the balance at the end of October was 132,500. So that also belongs on the right side of the equation. Total purchases on account during October were 281,000. So as they bought supplies or whatever it is that they purchased, instead of paying cash for those right away, they said bill me later. Well, just because they said bill me later and they bought them on account doesn't mean that they don't have to record that transaction now. It's just rather than recording the reduction in cash, they have an accounts payable instead. And so in order to increase the balance of an accounts payable account, it's a liability, and liabilities are increased with credits, right? So then we put our purchases here for $281,000. Now they're asking us to fill in the blank, basically. So if we start with 152,000, we buy 281,000 during the month. That's $433,000, but they're telling us that our ending balance is 132,500, which means somehow our account decreased from 433,000, which is the sum of these two, it decreased to 132,500. So if you take 433,000 minus the 132,500 ending balance, that means that during the month of October, our accounts payable balance decreased by $300,500 because those were payments that we made to our vendors. So in order to decrease a liability account, in this case specifically how to decrease the accounts payable account, we do that with debits, right? So debits belong on the left side of the T account, paid cash of $300,500. So then you sum your credit side less the sum of your debit side, and that's how you get to this ending balance of $132,500. Okay, so then we can take that answer and populate it here in letter A. Okay, so in part B, they say that September 30th, Valerian Company had 102,500 in accounts receivable. During October, they collected 102,890. They had a balance at the end of October of 89,000, so they're asking us to solve for the amount of sales on account that occurred during October. So accounts receivable has one of those key words, right? So that's an asset account. In asset accounts, you debit to increase and you credit to decrease. So when they give us the beginning balance in the accounts receivable account, that belongs on our left side of our T account, 102,500. Now the collections that they receive from their credit customers. So if I make a sale on credit to my customers, my journal entry is credit revenue, debit accounts receivable. Okay, you credit revenue to increase, you debit accounts receivable to increase. And so then when we collect that money, our accounts receivable balance goes down when our customers pay us and we get cash instead. So our accounts receivable goes down and our cash balance goes up. So in order to decrease an asset account, do you debit or do you credit? You credit, right? So the collections are going to go on the right side of your T account for $102,890. Then they give us the ending balance and they say the ending balance is $89,000. And so what they're asking us to solve for is the debit or credit related to the sales that happened during the month of October. And so the question is, if you make sales on account, you want to increase your accounts receivable balance, right? And so how do we increase our accounts receivable balance? It's an asset account. And we've said that we increase assets with debits, right? So they're asking us to fill in the missing debit for the sales that were made during the month of October. And so you can do this one of two ways. It's almost like an algebra problem, really, which I know I say that and probably scare a lot of you, but what we're trying to say is $102,500 minus, because the credits are reductions, minus $102,890 plus X, okay, equals $89,000. And so what we need to do is solve for X, right? So if you subtract the 102.5 from both sides, and if you add this 102,890 to both sides, then what you're left with is X is equal to 89,000 less 102,890, or less 102.5 plus 102,890, right? So let me get out my handy dandy calculator to do that math. So 89,000 minus 102,500 plus 102,890 equals 89,390. That's our debit. So you have original balance of 102.5. We have sales on account increasing our balance by 89,390. We collected 102,890 from our customers, and that's how we get to our ending balance of 89. So our sales on account, 89,390. Okay. All right, so in part C, during October, Almeda Company had 102,500 of cash receipts and 103,150 of cash disbursements. The October 31st cash balance was 18,600. And so what they want us to do is determine how much cash the company had at the close of business on September 30th. So the beginning of the previous, or the beginning of this month or the end of the previous month. So we put our T account cash here. And so let's fill in what we know. So we know that during October, the company collected cash of 102,500. And so that would mean our cash balance is increasing. And in order to increase our cash balance, cash is an asset and assets are increased with debits. Debits belong on the left side of our T account, right? So we have receipts of 102,500. We have disbursements of 103,150. So those are decreases to cash, right? So if we debit to increase cash, that means we must credit to decrease it. So our disbursements go on the right-hand side of our T account. And then our cash balance at the end of the month was 18,600. So if we put the balance here at the bottom, cash has a normal balance of a debit, so it belongs on the left side. And so they're asking us to solve for how much cash the company had at the close of business on September 30th. And so we're basically backing into the beginning balance. That's what they're asking us to do. And so X equals, or I'm sorry, X plus 102,500. Let me start over here. All right. Oops. Okay. So X plus 102,500 minus 103,150 equals 18,600, right? So if we do the same thing and we solve for x, let's subtract 102,500 here, add 103,150 here, which means we subtract 102,500 from this side as well, and we add 103,150 to this side. So this is 0 and 0, which leaves x equal to, and if we do that math, 18,600 minus 102,500 plus 103,150, that must mean our beginning balance is 19,250. September 30th, 19,250, and so they ask us what's our cash balance on September 30th. This 19,250 gets populated there in the answer. Okay? Okay, so here's another problem that's exactly the same as the one we just went through. So let's look at A, B, and C on this one and see how you do. So in part A, they're asking you to solve for the payments on accounts in October. So why don't you pause the recording, try it out on your own, using the same method that we did in the previous one, and then you can resume the recording and see how you did. Okay, so in A, Quarantine Company had 150,000 of accounts payable on September 30th, 140,200 on October 31st. Total purchases on account during the month of October were $240,000, and they ask us to determine how much cash was paid on accounts payable during October. So if we set up our T account for accounts payable, which is a liability, right? And we know that liabilities have normal balances of credits. They're increased by credits and they're decreased by debits. We know that debits go on the left side of the T account and credits go on the right side of the T account. Okay, so $150,000 is the starting balance. That belongs on the right side. Then we know that the balance at the end of October was 140,200. That belongs on the right side as well. We know that purchases on account during October were $240,000. So then we have to determine how much cash was paid on accounts payable during the month. Well, purchases on account increase our accounts payable balance, so that goes on the right side as well. And then we're solving for X, right? So again, $150,000 plus $240,000 minus X equals $140,000, 200. So if we subtract 150,000 from both sides of our equation, it's 0 here. If we subtract 240,000 from both sides of our equation, then we're left with 0 here, and what we have is X is equal to $249,800, right? So our cash paid is $249,800. Hope you did well on that one. Let's look at part B. So in part B, Valerian Company had a $120,000 balance in accounts receivable. Receivable is one of those key words that indicates it's an asset account, right? During October, the company collected $106,000 from its credit customers. And on October 31st, the balance in accounts receivable was $89,000. So determine the amount of sales on account that occurred in October. So why don't you take a minute, pause the recording, see if you can't work through this on your own, and then resume the recording and we'll go through the answer. Okay, so our first step is to set up our T account for accounts receivable. We set accounts receivable as an asset account. In order to increase asset accounts, we debit. Asset accounts have a normal balance of a debit, right? And so debits belong on the left side of the T account. And so let's put in the information that they tell us. So they tell us the beginning balance, or the balance on September 30th, is $120,000. They tell us that during the month, the company collected 106 from its credit customers. When they're collecting their accounts receivable money, that's a decrease to accounts receivable, and we know that accounts receivable is an asset, and in order to decrease asset accounts, we credit. So the collections belongs on the credit side of our T account, or the right side, right? And then they tell us that the balance at the end is $89,000. And so they're asking for us to solve for the amount of sales that occurred during October. Well, sales on account increase your receivable balance, right? So if we do a little bit of algebra here, we start at $120,000. That looks like an 8. All right, collections are a decrease, right? So minus $106,000 plus X, right? That's what we're solving for, equals $89,000. Okay, so if we subtract 120,000 from each side, and we add 106,000 to each side, then what we're left with, 0, 0, we're left with X equals 89,000 plus, or I'm sorry, 89,000 minus 102,000, or geez, let me start over. 89,000 minus 120,000, how about that? Plus 106,000 equals $75,000. So that means that our sales on account during the month of October are $75,000. Hope you did well on that one. Let's look at one more, part C. Okay, so during October, Almeda Company had $135,000 of cash receipts, $120,000 of cash disbursements. The October 31st balance was $51,000. And so they're asking us to determine how much cash the company had at the close of business on September 30th. So why don't you take a few minutes, pause the recording, attempt this on your own, and then we can check your answers and see how you did. Okay, so our cash account, put our T account on the paper or on the whiteboard or whatever it is that you're using. So they tell us that the company had $135,000 of cash receipts. So we're talking about the cash T account, and we know that cash is an asset, and to increase assets, we debit. To decrease assets, we credit. And we know that the debits belong on the left side of the T account, and the credits belong on the right side of the T account. So cash receipts are increasing our balance, so we know that to increase our balance, we need a debit, so that's the left side of our account. We know that disbursements are decreasing our cash balance, right? And to decrease cash, it's a credit, so that belongs on the right side of our T account. Then we have October 31st, our ending cash balance was $51,000, so we know that cash has a normal balance of a debit, so it belongs on the left side. And they're asking us to solve for the beginning cash balance. So in this case, it's X is equal to, or X plus, sorry, 135,000 minus 120,000 equals 51,000. So if we subtract 135,000 from both sides, and if we add 120,000 to both sides, then what we're left with is 0, 0. All we're left with is X equals, let me get out my handy dandy 10 key. Don't tell anybody. So we have 51,000 minus 135,000 plus 120,000. That means our beginning balance is 36,000. Okay. So hopefully you did well on all of those. Let's look at the next concept. All right, so they're asking for us to prepare journal entries in this problem. And so they give us a bunch of transactions about Pose for Pics Company, and they're asking us to record the journal entries in the general journal. Okay, so on August 1st, Madison Harris, the owner, invested $6,500 cash and $33,500 of photography equipment in the company in exchange for common stock. So we know that when we make journal entries or we record transactions, there has to be at least two accounts that are affected. But in this one, we have cash, we have photography equipment, and we have common stock. So typically the debits are the lines that should be first, and then the credits should be the lines below the debits when you're doing a journal entry, but really in practice it happens either way. It doesn't really matter, but for purposes of this class, we're going to do it that way. So if Madison Harris is investing cash in the company, the cash balance is going up. And how do we increase a cash balance, a debit or a credit? Debit, right? So we put our date in, cash, debit is $6,500. And then we also know that Madison Harris is investing $33,500 of photography equipment into the company. And so the company is getting equipment, and so our balance is going to go up. And to increase the balance in an asset account, equipment, we debit, right? So we have a debit of $33,500 for photography equipment. And then in exchange, the company is giving Madison Harris common stock for the total of the two, right? So common stock is an equity account. And to increase the common stock account, do we credit or do we debit? I mean, your debits have to equal your credits too. And this is the last line in the entry. So looks like we need a credit, right? For $40,000. All right, in transaction 2, on August 2nd, the company paid $2,100 cash for an insurance policy that covers the next 24 months. So our two accounts that are affected are cash and what we're going to call prepaid insurance because it covers the next 24 months in the future. And so in order to increase the prepaid insurance asset account, we do that with a debit, right? And then we're paying cash out the door. Cash is an asset. To decrease cash, we credit. August 5th, company purchased supplies for $880 cash. So our two accounts that are affected are supplies and cash, right? And so they're getting supplies, so our supplies account is increasing. Supplies is an asset, and to increase assets, what do we do? Debit or credit? Debit, right? And then we're paying cash out the door. Cash is an asset. To decrease asset accounts, we credit. On the 20th, the company received $3,331 cash in photography fees earned. So we got cash and we got photography fees, right? So photography, that's the business they're in, so that's their revenue. So in order to increase cash, cash is an asset, we debit, right? And then photography fees is a revenue account, and in order to increase revenue accounts, what do? Credit, right? All right, then August 31st, the company paid $675 cash for utilities. So our two accounts affected are cash and utilities. And so utilities expense is going up. And in order to increase utilities expense, or any expense account for that matter, we debit. So we have utilities expense, debit. And then cash is going out the door because we paid the bill, right? So in order to decrease cash, cash is an asset account. We decrease asset accounts with credits. There you go. Okay, now it's your turn. So take a minute, prepare the journal entries for these 5 transactions for Pose for Pics, and then you can resume the recording and we'll go through the answers and see how you did. Okay, so in transaction 1 on August 1st, Madison Harris invested cash and photography equipment in the company in exchange for common stock. So our three accounts that are affected are cash, photography equipment, and common stock, right? So in order to increase cash, we debit because cash is an asset. We have photography equipment, which is also an asset, and to increase asset accounts, we debit as well. And then common stock is a equity account, and that particular type of equity account is increased with credits. So we have credit of $57,000. On August 2nd, the company paid $3,800 cash for an insurance policy covering the next 24 months. Our two accounts affected are cash, and then we're going to have prepaid insurance because it's covering future months. So in order to increase our asset account prepaid insurance, we debit. In order to decrease our asset account cash, because we're paying money out the door, we decrease asset accounts with credits. So on August 5th, the company purchased office supplies for $2,400 cash. Our two accounts are office supplies and cash, right? So we're getting office supplies, so that balance needs to increase. Office supplies is an asset. We increase assets with debits. Cash is going out the door. Cash is an asset as well. In order to decrease asset accounts, we credit. On August 20th, the company received $3,300 cash in exchange for, for revenue rather, for photography fees earned. So when the company receives that cash, our cash balance is going up, right? And then they're earning revenue or performing services. So they have photography fee revenue. Revenue is a equity account that is increased with a credit. Then on August 31st, the company paid $600 cash for August utilities. So our two accounts affected are cash and utilities, right? And so utilities expense is going up, right? So in order to increase an expense account, we debit. And then cash is going down because we've sent the money out the door, right? So to decrease our asset account cash, we're going to credit. Hopefully you found yourself scoring well on those. And let's move on to the next concept. So preparing T accounts. So what they want us to do is use the information below to prepare an August 31st trial balance for pose for pics. Begin by using these opening T accounts: cash, office supplies, prepaid, photography equipment, common stock, photography fees earned, and utilities expense. Then post these general journal entries to the T accounts, which will serve as the ledger and prepare the trial balance. Okay? So there's all of our transactions or our journal entries that we posted. Okay, so here's all the journal entries that we posted, or we recorded rather, and now what they want us to do is post them to the general ledger, and in this case we're going to use T accounts to fit it all on the same slide. So there's our journal entries that we recorded. So if we create our cash T account, what we're going to do is we're going to transfer each part of these journal entries into the appropriate side of the T account. So cash debits belong on the left side of the T account, right? And credits belong on the right side. So our first entry, we're going to take our August 1st cash and we're going to post it to the left side of our T account. And then we have photography equipment for $33,500. That's also a debit, belongs to the left side of our T account. Then we have common stock. Common stock is a credit. That gets posted to the right side. Prepaid insurance, we have a debit of $2,100, so that gets posted to the debit or the left side of the T account. Then we have cash credit for $2,100, so that gets posted to the right side of our cash account. Then we have office supplies. Our debit for $880 goes to the left side. Then the other side, the credit side of that transaction is cash, so we have another transaction there on the right-hand side of our cash T account. Then we have our August 20th cash we collected for photography fees. That's a debit. Debits get posted to the left side of the T account. Then we have photography fees earned. It's a credit. Credits get posted to the right side of the T account. We have utilities expense for $675. Debits go to the left side. And then we paid cash for those utilities. It's credit. Credits go to the right side. Okay. Then we can sum up the debits less the credits. So we have a balance in cash of $6,176. Sum up our debits less our credits and photography equipment. Leaves us with a debit or a normal balance of $33,500. Sum up our common stock, credit balance of $40. Sum up our office supplies, debit balance of $880. Sum up our photography fees earned, gives us a credit balance of $1,331. Sum our prepaid insurance debits, so that leaves us with a debit of $2,100. Utilities expense, sum that up, leaves us a balance of $675, a debit balance or a normal balance. So then, if we prepare the trial balance from there, remember we said the trial balance is really just the process of transferring the balances from each of our accounts into a list. So we have Pose for Picks, trial balance, as of August 31st. We have our debit column, our credit column. So first let's bring over all of our asset accounts. So we have cash. Cash is an asset, belongs in the debit side. Office supplies is also an asset, belongs on the debit side. Prepaid insurance, same thing. Photography equipment, same thing. Then we have common stock. Common stock is an equity account whose normal balance is a credit. So that belongs in the credit column. Then we have photography fees earned, which is revenue. Revenue, normal balance of a credit, belongs on the credit side. Then we have utilities expense. Expenses are debits, so they belong on the left-hand column. And then we sum our debits and our credits, and we hope they equal, right? If they don't, something's gone wrong. And they do. All right, so now why don't you try the same thing? Prepare the T accounts, and then prepare the trial balance from these transactions. And then once you're finished, you can resume the recording, and we can go through the answers. All right, so here's all of our journal entries. So let's start with our T account cash. Cash has a debit of $10,700. Debits belong on the left side. Then we have the T account for photography equipment. It's also a debit, so it belongs on the left side. And then we have common stock. Common stock has a normal balance of a credit. It's increased by credits. We have a credit there of $57,000, so it belongs on the right side. Then we have prepaid insurance. Prepaid insurance is an asset account. We've got a debit there of $3,800. Debits belong on the left side. Then we also have a credit to cash from that August 2nd transaction. So credits go to the right side of our cash T account. Then we have office supplies. Debit of $2,400 gets posted to the left side of our T account. Cash gets posted to the right side of our cash T account for $2,400. Then we have our cash for $3,300 from August 20th. It's a debit. Debits belong on the left side of our T account. And we have photography fees earned. That's a revenue account. Revenues are increased by credits. Credits get posted to the right side of our T account. Then August 31st, we have utilities expense. To increase expense, you debits. So we put that on our left side of our T account. And then we have cash, credit of $600, and credits belong or get posted to the right side of our T account. All right, so after we have posted all of our transactions to our T accounts, then we sum all of our asset account debits less all of the credits. So we have a balance in cash of $7,200. Same thing for photography equipment. Debits less credits, balance of $46,300. Same thing for prepaid insurance, supplies. Then common stock, some of our credits less our debits. Photography fees earned, some of our credits less our debits. And then utilities expense, some of our debits less our credits. And so then we have all of our balances here in each of our accounts. And then we prepare the trial balance, right? So, name of the company first, pose for pics. Trial balance for the period of August 31st. Count titles, debits in the left column, credits in the right column. And then asset accounts go first, right? So you have cash. Cash is a debit, 7,200. Office supplies. Office supplies are asset accounts. Asset accounts have a normal balance of a debit. Prepaid insurance, also an asset. Assets have normal balances of debits. Photography equipment, also an asset. And then we move on to, we don't have any liabilities in this example. So we move on to common stock. Common stock has a normal balance of a credit. It gets posted to the right side or the rightmost column of your trial balance. Then we have revenue. Revenue also gets posted to the right side. Credits increase revenue. Revenue has a normal balance of credit. And we have utilities expense. Expenses have normal balances of debits. Debits belong in the left column. And then you sum up all of your debits and you sum up all of your credits. $60,300 total debits, $60,300 total credits. So our debits and our credits equal, and we are good to go. Okay, in this example, they're asking us to record the journal entries for the Spade Company using the following accounts: cash, AR, office supplies, office equipment, AP, common stock, dividends, fees earned, and rent expense, and to use the letters beside each transaction to identify the entries. And then after we're done recording the transactions, we'll post them to the T accounts, which is going to serve as the general ledger for this assignment. And then we're asked to determine the ending balance in each T account. So let's look at each of these transactions. So in A, Casey Spade, owner, wonder where they got that name, invested $100,750 cash in the company in exchange for common stock. So the first question we ask ourselves is what two accounts are affected, right? And we see cash here in the description and also common stock, right? So Casey Spade, the owner, invested cash in the company, so the company's receiving cash. So the balance in the cash account has to go up, right? And the company is giving Casey Spade common stock. So the balance in common stock is also going to go up, right? So in order to increase cash, cash is an asset, we debit, right? Then our credit's a common stock for $100,750. So then if we post the transaction to the T accounts, our first T account there is cash. Debits go to the left side of the T account, right? And common stock, the credit of $100,750. Common stock, the credits go to the right side of the T account. Okay. Right, in transaction B, the company purchased office supplies for $1,250 cash. What two accounts are affected? Office supplies, right? And cash. Both are going, well, office supplies is going up, cash is going down. Right? So in order to increase the asset office supplies, we debit. In order to decrease the asset account cash, we credit. And then we post those to the T accounts. So our debits go to the left side. Our credits go to the right side. In transaction C, the company purchased $10,050 of office equipment on credit. So what two accounts are affected? Office equipment. And when they say on credit, basically that means we're going to pay for them later. So we have a liability, an account payable for that office equipment. Okay. So in order to increase our asset office equipment, we debit. And in order to increase our accounts payable, we credit. And we post those to the T accounts. So our debits go to the left side. Our credit and accounts payable gets posted to the right side. Then in transaction D, the company received $15,000 cash as fees for services provided to a customer. So what two accounts are affected? Cash and then fees for services, right? So our cash is going up. We received cash from our customer, right? So we're going to debit cash because cash is an asset, and in order to increase assets, we debit. And then we're going to recognize fee revenue or fees earned for $15,000 revenue to increase, you credit. We post them to the T accounts. So there's your transactions in cash from Part A and Part B. So we're going to record $15,000 cash on the debit side or the left side of the T account. We're going to record fees earned to the credit side or the right side of the T account. Okay, so the company paid $10,050 cash to settle the payable for the office equipment that they purchased in transaction C. So we originally created an accounts payable liability account with a credit of $10,050, and what they're telling you is that they've now paid for that equipment. So we need to reduce our payable, and then we also need to reduce cash. So accounts payable, we're going to debit for $10,050. That's going to reduce our balance. It's a liability. Liabilities are reduced by debits. And then we're going to reduce our cash account. Our cash account's an asset. And in order to decrease asset accounts, we credit. So then we post our transaction to the T account. So see in transaction C, we had that $10,050 on the credit side or the right side of our accounts payable T account. Now in transaction E, we're paying for it. And so we're going to reduce the balance and we're going to post that to the left side of our T account. And then in our cash account, we're going to record the reduction to cash or the credits to the right side of our cash T account. All right, in transaction F, the company billed a customer for $2,700 as fees for services provided. And so what two accounts are affected? So we billed the customer, so we haven't gotten cash yet. And we billed them for fees. So when we bill a customer and we haven't yet collected the cash, we record what we call an accounts receivable, right? It's money owed to us that the customer hasn't yet paid. They're going to pay for sometime in the near future. So we want to increase our asset account, accounts receivable, and we also want to increase our revenue, our fees earned revenue, by that $2,700. So in order to increase our accounts receivable, we debit. It's an asset account. And in order to increase our fees earned, we credit. Revenue accounts are increased by credits. And we post our transactions to our general ledger or our T accounts. So we post our debits to the left side. And then for our fees earned, we post our credits to the right side. All right, in transaction G, the company paid $1,225 cash for monthly rent. So what two accounts are affected? Cash and rent, right? So cash is going to decrease and rent expense is going to increase. And so in order to increase rent expense, we debit. In order to decrease cash, we credit. We post our transactions to our general ledger or our T accounts in this case. And so our debit for rent expense gets posted to the debit side of the T account, or the left side. And our cash, we're going to reduce our cash. Reductions or credits in cash get posted to the right side of our T account. In transaction H, the company collected $1,125 cash as a partial payment for the accounts receivable that was created in transaction F. So the two accounts that are affected are cash, right, and accounts receivable. So they've received some of that accounts receivable from their customer, and so our cash is increasing and our accounts receivable is decreasing because they're paying it off, or part of it anyway. So in order to increase our cash, we debit. In order to decrease our accounts receivable, we credit. So we post our debit to cash to our left side of our T account. We post the credit to accounts receivable to the right side of our T account. Right, and then in transaction I, the company paid $10,000 cash and dividends to Spade, who's the sole shareholder. So our two accounts that are affected are cash and dividends, right? So we're paying cash out the door, so that balance needs to decrease, and cash is an asset, and we decrease assets with credits, right? We're going to pay dividends, so that means the dividend account itself needs to go up, which has an inverse relationship to equity. But in order to increase the dividend account, we want to debit. So we're going to debit dividends for $10,000, and we're going to credit cash for $10,000. And then we're going to post our transactions to the T account. So debits get posted to the left side, credits get posted to the right side. All right, so here we have all of our transactions A through I posted to our general ledger and or our T accounts in this case. And so what they're asking for us to do from here is to come up with what the ending balance is. So in our cash account, we're going to add all of our debits less all of our credits. And we have a normal balance of a debit of $94,350. Office supplies, or I guess let's go over to common stock. Common stock, we've got just the one transaction on the credit side, so we have a credit balance of $100,750. Then office supplies, we have just the one transaction on the debit side. Same thing with office equipment. Accounts payable, we have a credit of $10,050, and then we also have a debit of $10,050, so we have a zero balance in accounts payable. And then in fees earned, we have the two different credits for a total of $17,700. Accounts receivable, we start with the debit of $2,700 less the partial payment we received to credit of $1,125 for a balance of $1,575. Then we have rent expense, the only debit there, so our balance is $1,225. And then same thing with dividends, just the single debit there, so our balance is $10,000. Okay, so in this transaction, it's the exact same thing as we just went through. Why don't you take a few minutes and see if you can record the general ledger, or the journal entries rather, and then post them to your general ledger T accounts and compute your ending balances. And then when you think you're through, you can resume the recording and see how you did. All right, so hopefully you were able to get through those journal entries without a whole lot of trouble. Let's run through them here and see how well you did. So Casey Spade, owner, this time invests $11,250 cash in the company in exchange for common stock. What two accounts are affected? Cash and common stock. Cash is going to go up. Common stock is also going to go up for $11,250. So to increase our asset cash account, we debit. To increase common stock, we credit. Post them to our T accounts. Debits get posted to the left side, credits get posted to the right side. So the company purchased office supplies for $300 cash. So the two accounts that are affected are office supplies and cash. Office supplies are increasing, cash is decreasing. So to increase our asset account office supplies, we debit. To decrease cash, we credit. Post our transactions to the general journal, or the T accounts in this case, or general ledger, sorry. Debits get posted to the left side. Credits get posted to the right side. In transaction C, the company purchased $6,200 of office equipment on credit. So office equipment is going up, and the amount that we owe in the future, because we bought it on credit, is also going up, our accounts payable, right? So in order to increase our asset account office equipment, we debit. In order to increase our accounts payable, because we bought it on credit, we credit. And then we post our transactions to our T accounts. So debits get posted to the left side, credits get posted to the right side. In transaction D, the company received $1,300 cash as fees for services provided to a customer. And so our cash account is being affected, and our fees earned, our revenue account, is also being affected. Cash is going up and revenue is also going up. So in order to increase our cash account, we debit. In order to increase our fees earned, or our revenue account, we credit. And we post our transactions to our T accounts. Debits get posted to the left side. Credits get posted to the right side. So the company paid $6,200 cash to settle the payable from the office equipment that we bought in transaction C. So our cash is going to go down, and so is our accounts payable, right? They're paying for some of that. So in order to decrease our accounts payable, it's a liability, we decrease liabilities with debits, and we decrease cash with credits. And then we post our transactions. So the accounts payable debits get posted to the left side. The cash credits get posted to the right side of the cash T account. Okay, the company billed a customer for $2,300 as fees for services provided. So we're going to bill a customer, so our accounts receivable is going to go up, and our fees, or fees earned, or revenue account, is also going to go up. And so we increase our accounts receivable asset account with a debit. We increase our fees earned revenue account with a credit. And then we post our journal entry to the T accounts, or the general ledger. So our debits for accounts receivable get posted to the left side. Our credits for fees earned get posted to the right side. In transaction G, the company paid $500 cash for monthly rent. And so our cash balance is going to go down. Our rent expense balance is going up, which in turn is going to reduce our equity account. So rent expense, we increase expenses with debits. We decrease cash with credits. Then we post our journal entry to the T accounts. So our rent expense debits get posted to the debit side, or the left side. The cash credits get posted to the right side. And in transaction H, the company collected $1,000 cash as a partial payment for that accounts receivable that we created in transaction F. So we collected cash, so our cash account is going to increase. Our accounts receivable is going to decrease. So to increase our asset account cash, we debit. To decrease our asset account accounts receivable, we credit. We post it to the T account. So on the left side, there's our $1,000. Then in accounts receivable, to reduce accounts receivable on the right side, we credit. So in transaction I, the company paid $3,000 cash in dividends to Spade, the sole shareholder. Our two accounts that are affected are dividends and cash, right? So in order to increase our dividends account, we have to debit, although it has an inverse relationship with equity, right? So as our dividend account increases, our equity balance decreases. Anyway, so dividends, we're going to debit for $3,000. Cash, in order to decrease cash, we credit for $3,000. Then we post our transactions to the T accounts. So our debits get posted to the left side, credits to cash get posted to the right side. All right, and so here's all of our T accounts and the activity that we've posted in A through I. And so then we sum for our ending balances. So cash, our debits less our credits, balance of $3,550. Common stock, we just have one credit, so we have a credit balance of $11,250. Office supplies, we have one debit, $300. Office equipment, we have one debit, $6,200. Accounts payable, 0. Fees earned, we have $3,600. Accounts receivables and asset account, debits less your credits, balance is $1,300. Rent expense, debits are $500. Dividends, just the one transaction debit. So we have a total of $3,000. Okay. So I hope you did well on that. Let's look at the next concept. All right, so the transactions that we just recorded in the previous problem, both the one you did on your own and the one that we worked through together, we're going to take those transactions and they're asking us to prepare a trial balance as of May 31st. So across the top and down the left-hand side of this slide are all of our balances, and they're asking that we prepare the Spade Company trial balance as of May 31st. And so again, once you do all of the work of recording the transactions, really it's just a matter of transferring the balances to the trial balance or to a list, basically. And the only trick really is to make sure that you get your debits and your numbers in the right columns, your debit and your credit. All right, so let's bring down our asset accounts first. So we'll start with cash. Cash has a normal balance of a debit, right? It's an asset. Then we have accounts receivable, also an asset, belongs in the debit column. Office supplies, same thing. Office equipment, also an asset, debit side. And then we have an accounts payable, that's the liabilities. So liabilities have a normal balance of a credit, so that goes into the credit column. Although it's 0, so there's no number to put there. Then we have common stock. Common stock is a equity account, but it's one of the equity accounts that is increased by credits and therefore has a normal balance of a credit, so it belongs in the credit column. Dividends is an equity account, however, it has a normal balance of a debit. It has an inverse relationship with equity, so it belongs in the debit column. Fees earned, that's a revenue account. Revenues belong in the credit column. And then rent expense. Expenses have debits as normal balances, and that belongs in the debit column. And you can sum up all your debits and your credits, and if they equal, you know you've done it right. All right, this is the exact same problem, but it's using the balances from the one that you did previously where you recorded all of those individual journal entries, A through I, and we computed the ending balance in each of our ledger accounts. So why don't you take those ending balances and prepare the trial balance. Pause the recording, see how well you do, and when you think you're done and or you are stuck, resume the recording and we can go through the answers. Okay, so here are all your balances from the previous problem. And what they had asked you to do was take each of these balances and create the trial balance as of May 31st. So the first thing, Spade Company, heading first, company name, then the name of whatever it is you're doing. In this case, we're doing the trial balance. They told us to compute or prepare the trial balance for May 31st. So you have your account title, your debits, and your credits. And then we start to transfer all of our balances, right? So asset accounts first. And asset accounts have a normal balance of a debit, so all of those numbers belong in the debit column. Then we have liability accounts next. Liability accounts have a normal balance of a credit, they belong in the credit column. And then we have common stock, that's an equity account, but it's one of the equity accounts that has a normal balance of a credit, so that belongs in the credit column. Dividends, also an equity account, but dividends works the opposite. It has a normal balance of a debit. And you have your revenues, normal balances of credits, your expenses, normal balance of debits, sum all of your debits, sum all of your credits, and if they are equal, you are in business. Easy peasy lemon squeezy, right? It will be. Hang with me. Okay, so in this problem, they're asking us to compute the net income, basically. And so corporation had the following assets and liabilities at the beginning and end of the year. And then they ask us to determine the net income or net loss incurred by the business during the year in each of the following 4 separate cases. So they give us the beginning of the year assets and liabilities, and so we can compute the beginning of the year equity, right? Because we know that assets equal liabilities plus equity. And so if assets are 60,000 and liabilities are 20,000, that must mean equity is 40, right? And 40 is going to be true for all 4 cases. And then if we know that assets are 105,000 and liabilities are 36,000, let me get out my handy dandy 10 key. Don't tell. Shh. 105 minus 36. That means that total equity is $69,000 at the end of the year, right? That'll be true for all 4 circumstances. So, in part A, the owner made no investments in the business, meaning that there was no common stock, and no dividends were paid during the year. So in part A, if beginning of the year equity is 40 and end of the year equity is 69, 40 minus 69 is what? 29, right? So we had 0 investments by stockholders, we had 0 dividends, we had $29,000 of income, right? So in part B, the owner made no investments in the business, but dividends were $1,250 per month. So investment by stockholders, 0. Dividends are $1,250 per month, and they tell us that it's a year worth of activity, right? So $1,250 times 12. That means they paid $15,000 in dividends, and that's reducing our equity, so it's reported as a negative number. And so we can solve for x. So if I write out our algebra problems like we were doing earlier, 40,000 minus 15,000 plus x equals 69,000, right? So if we solve for x, we subtract 40 from each side. We add 15 to each side. So 69, that makes this 0. That makes this 0. All we're left with is x. So x is equal to 69 minus 40 plus 15, or $44,000, right? In part C, they tell us that no dividends were paid during the year. The owner did invest an additional $55,000 in cash in exchange for common stock. So our investments for our dividends are 0, but our investment by stockholder is going to be an increase of $55,000. And they're asking for us to solve for net income. So if I erase my previous algebra problem and we write a new one, this one's going to be 40,000 plus 55,000 plus X equals 69,000. So if we subtract 40 from both sides, we also subtract 55 from both sides, we're left with X equals 69 minus 40 minus 55, or a net loss of $26,000. And then in the last one, they say the dividends were $1,250 per month. So $1,250 per month times 12 months. And dividends are going to be $15,000. Excuse me. And then the owner invested an additional $35,000 in cash in exchange for common stock. And then we're going to solve for X again. So let me erase my previous math here. And our new algebra problem is going to be 40 plus 35 minus 15 plus X equals 69, right? So if we subtract 40, we subtract 35, we add 15 to both sides. So minus 40 minus 35 plus 15. X is equal to 69 minus 40 minus 35 plus 15. It's $9,000. Okay. Okay, so here's the exact same problem, just some different numbers. It's very similar to the one we just went through. So why don't you take a minute, pause the recording, walk through A through D, see if you can come up with the net income earned or the net loss incurred by the business for each of the following cases. And then when you think you're finished and or you are stuck, you can resume the recording and we can walk through it. Okay, so again, we know that assets are equal to liabilities plus equity, right? So if we have assets of 85,000 and we have liabilities of 35,000, that must mean that equity is 50, right? Okay, and that's going to be true for all four cases. And then at the end of the year, if assets are 130 and liabilities are 50, that must mean the end of the year equity is 80. Okay. All right, so in letter A, the owner made no investments in the business and they paid no dividends during the year. So both of those numbers are 0. And so if we solve for net income, 50 plus what number is 80, right? 30,000. All right, in part B, they say the owner made no investments in the business, but dividends were $2,000 cash per month. Well, there's 12 months in a year, right? 2 times 12, 24. So we have 0 investments by the stockholders, but they paid dividends of 24,000. Those reduce your equity, so they're showing up as a negative number. And then they want us to solve for X, right? So 50 minus 24 plus X equals 80. So if we add 50 and let me back up. If we subtract 50 and we add 24 to both sides, that leaves us with X equals 80 minus 50 plus 24, right? So $80,000 minus 50,000 plus 24,000. X is equal to 54,000. Okay, and then in letter C, they say no dividends were paid during the year, but the owner did invest an additional $45,000 in cash. So investments by the stockholder will increase our equity. And then we have to solve for net income here. So let me erase my previous math. All right, so here we have 50,000 plus 45,000 plus x equals 80, right? So if we subtract 50 and we subtract 45, that'll make this 0. So all you have left on that side of the equation is x. X is equal to 80 minus 50 minus 45, right? So 80 minus 50 minus 45, that means we have a net loss of $15,000. Then in letter D, they say the dividends were $2,000 cash per month and the owner invested an additional $35,000 cash in exchange for common stock. So our dividends are going to be 2,000 times 12, it's negative 24. We have an additional investment from the stockholders of 35, and then we have to solve for x, right? So, all right, so our formula becomes 50 plus 35 minus 24 plus x equals 80, right? So if we subtract 50, we subtract 35, and we add 24 to both sides of our equation, then we end up with x is equal to 80 minus 50 minus 35 plus 24, right? So $80,000 minus $50,000 minus $35,000 plus $24,000 is $19,000, right? Okay, so hopefully you did well on those. And let's look at the next concept. Okay, so in this exercise, what they're asking us to do is prepare an income statement. So Carmen Curie operates a consulting firm called Help Today. Operations began August 1st, and on August 31st, the company's records show the following accounts and amounts for the month of August. So they want us to use this information and prepare the income statement for the business. Okay, so one of the first things I would do is I would set up your statement, right? So we talked about, I think earlier in this presentation or maybe in a previous one, I can't remember, we talked about not losing the easy points on forgetting to set up your statements correctly. So the first thing we want to do is make sure that our statement heading is correct. And so they have the company name already there, Help Today. They've labeled it, it's the income statement. And so we need to fill in what income statement for what period. And so in this case, it's for the month ended August 31st, okay? And then we want to set up our sections of our statement, right? So you want a heading for your revenue section, a heading for your expense section, and then you want to make sure you label that bottom line, which is known as net income or net loss, right? Then what I would do is I would go through all of the information that they provide us, all of the accounts, and determine what you need and what you don't need, because oftentimes they'll give you every account, but we don't need every account to prepare our income statement. We only need the revenue and expense accounts. And so cash, accounts receivable, land, equipment, all of those are all asset accounts. We don't need them. Accounts payable is a liability account. We don't need that one either. Common stock, that's an equity account. We don't need that for our income statement. And then dividends are also an equity account, so we don't need those for our income statement either. And then we're left with our revenue and expense items, right? So consulting fees earned is a revenue account. That belongs at the top of our statement. And then we put all of our expenses under the expense subheading. We total our expenses, $16,530. So we have $27,000 of revenue earned, less $16,530 of expenses. we have net income of $10,470. And so the one thing that I wanted to point out here on this slide is that the reason for the two columns, so you can add individual expense accounts here and have your subtotal here. If we had individual revenue accounts, we would put them here in the first column and we would subtotal them in the second column. Okay, so that's the purpose of the two columns on the income statement. And then from there, our net income would move to the statement of retained earnings. All right, so this is the exact same problem, just different numbers. So why don't you pause the recording, try to prepare the income statement yourself, and then resume the recording and you can see how you've done. Okay, so again, you want to make sure you have the right heading. So we have the company name. It's an income statement. It's for the month ended August 31st. Put our subheadings in there. So we have a revenue section, we have an expense section, and then we have net income or loss, right? And then we know we don't need any of our asset accounts. We don't need our accounts payable, nor our common stock, and nor our dividends, right? Those are reported on the statement of retained earnings. And we're left with revenues and expenses. And so our revenue, consulting fees earned, there is no subtotal needed for that one. So he can go in the far right column. And we have all of our expenses. Subtotal those. The subtotal belongs in the far right-hand column. Then we have revenues of $32,000, less expenses of $14,300 for net income of $17,700. Okay, how'd you do? Hopefully well. Let's move on to the. Okay, so let's move on to preparing the statement of retained earnings. So Carmen Camry operates a consulting firm called Help Today. Operations began August 1st. On August 31st, company's records show the following accounts and amounts, right? So it's the same information as the information provided to prepare the income statement. They just want us to prepare the statement of retained earnings now. So proper headings first. So we have our company name, statement of retained earnings. Statement of retained earnings is for a period of time, just like the income statement. So it's for the month ended August 31st. We start with retained earnings at the beginning of the period. In this case, they tell you that they began operations on August 1st, so our beginning balance is 0. Then we add net income. So in the previous example, not the one that you did by yourself, but the one that we did together, we computed net income to be these boxes in yellow, the sum of these accounts. So our revenues or our consulting fees earned less all of our expenses. And that we learned that that answer was $10,470 from our income statement. And then we want to subtract dividends. So dividends, they tell us, is $6,000. And then we get to our ending retained earnings balance, right? So you have 0 plus 10,470 minus 6,000 for an ending retained earnings balance of $4,470. And then that ending retained earnings balance ultimately goes to the balance sheet. Okay? So why don't you try the same thing? So this is a continuation of the problem that you did on your own to prepare the income statement. So using the same information here, why don't you pause the recording, prepare your income statement. When you're finished, you can resume your recording and we will go back through the answers. All right, so again, make sure your heading is appropriate. So you have your company name, the statement name. We're doing a statement of retained earnings, so those are for a period of time, and in this case, it's the period of, or the month ended, August 31st. We start with beginning retained earnings, which is 0 because they just began their operations. We add net income, so net income from the previous income statement that you prepared on your own was the sum of, or the net of, consulting fees earned, 32,000, less all your expenses, so 17,700, less dividends of 15,000, 0 plus 17,700 less 15,000 is $2,700, right? So hopefully you did well on that. Let's move on to the next statement, which is the balance sheet. Okay, so Carmen Carey operates a consulting firm. Same data, started August 1st. On August 31st, here's the balances and all of their accounts. They want us to use this information to prepare the balance sheet. So let's set up our balance sheet. So we have the company name, Help Today, balance sheet, name of our statement, right? And then the balance sheet, if you remember, is the only financial statement that is as of a date and time, not for a period of time, right? So our balance sheet is going to be as of August 31st. We have our assets. In this case, balance sheets can be presented either way. They're showing it side by side, but they can also be just vertically. And so your assets would be on top, followed by your liabilities, and then your equity. So in this case, they're going to do a side-by-side balance sheet, I'll say. So your assets are on your left side. Your total liabilities and equity are on your right side. And then we have our categories. So we have our assets. All of our assets are highlighted there in yellow. So we'll bring down our cash, our accounts receivable, our office supplies, our land, and our office equipment, for total assets of $116,970. Then we go to the left side, or the right side of our balance sheet. We have our liabilities first and then our equity, right? So our only liability account that's listed there is accounts payable. So we'll bring that one down. And then we have our equity section. We have common stock of 102,000, right? We have retained earnings from our statement of retained earnings, which is really the sum of your dividends. Well, it's the net of your revenue less all of your expenses, your net income, right? Reduced by your dividends for your ending retained earning balance. So we already computed that in the previous example and came up with $4,470. And so you take your accounts payable balance of $10,500 plus your common stock plus your retained earnings for total liabilities and equity of $116,970. And we are in balance, so we are good to go. Okay, so now why don't you take a few minutes and try to prepare this balance sheet on your own for Carmen Camry Company. Same information as you used to prepare the income statement and the statement of retained earnings in the previous slides. So why don't you pause the recording, see if you can put together a balance sheet, and then when you're finished, you can resume the recording and we can walk through the answers. Okay, so let's look at the balance sheet for Carmen Camry. So again, you want to make sure your heading is correct. You want your company name first, the name of the statement for which you're preparing, and then the date or the period for which you're preparing it. So in this case, it's a balance sheet. Balance sheets are for a point in time only. And so we'll use August 31st because that's the date they're giving us the balances above. We're all as of August 31st, okay? And then let's prepare a balance sheet. So you have your assets on the right or the left side. You have your liabilities and equity on your right side. Assets. So assets on the top left, liabilities on the top right, and then equity just below the liabilities. All right, so cash, AR, office supplies, land, and office equipment are all asset accounts. So those all belong here in your first section. Total assets of $122,200. Then we have accounts payable, which is our only liability account, $9,500. Then we have common stock of $110,000. We have the retained earnings balance, right, that you computed from your previous statement, which is your beginning retained earnings, which in this case is 0, less your dividends of $15,000, plus your revenue of $32,000, less your expenses, or otherwise said as the net of your revenue expenses, net income or net loss, right? And so you already computed that, so you just pull that balance from your retained earnings statement for total liabilities and equity of $122,200. Okay, so hopefully you did well on that. All right, I think this is our last example, maybe second to last. All right, so let's talk about changes in equity. So what they're asking us to do here is to compute the missing amount for each of the pieces, or each of the following separate companies, A through D. All right, so this is really just our algebra problems, right? So if we know the beginning of the year equity is 0, plus owner investments of 110, plus X, plus 22 equals 104, right? So let me get out my handy dandy pen. I'm actually using my finger on a touch screen. I really need to get a pointer, or a, what do you call those things? Stylus? I don't know, whatever they're called. My handwriting might be a little bit neater if I got that, but nevertheless, this works. So we have 110 plus X plus 22 equals 104, right? So if we subtract 110 and we subtract 22 from both sides, we have 0, 0, and then we're left with X, right? Equals 104. We have to subtract 110 and subtract 22. So X is equal to 104 minus 110 minus 22,000. 104. Oh goodness. I don't know how to use my calculator here. I know, yes, I'm using a calculator. 110 minus, or 104 minus 110 minus 22. So this must mean that we paid dividends out of $28,000 during the year, right? Let's look at letter B. So, okay, so in letter B, we have 0 to start the year. So we have X minus 47,000 plus 90,000 equals 85,000, right? So if we add 47, that makes that 0. We subtract 90, that makes that 0. So that means we have to do the same thing on this side of the equation. So we want to add 47. We want to subtract 90. So X is equal to 85 plus 47 minus 90. $42,000, right? Okay. So if we look at letter C, we have $87,000 minus 10 minus 4 equals what? That one's easy, right? We have ending equity of $73,000. All right, so then in the last example here, we have 210 minus 55 plus X equals 110, right? So we have to subtract 210, add 55 from both sides. $210 minus $210, 0, negative 55 plus 55 is 0. So we have X is equal to 110 minus 210 plus 55. X is equal to negative $45,000, right? So they had a loss that year. Does that make sense? All right. Okay, so this is the same exact problem as the one we just went through. Why don't you take a minute, pause the recording, solve for each of the missing pieces, and when you're done, you can resume the recording and check your answers. Okay, so in part A, we're going to solve for dividends during the year. So we have 91 plus X plus 87 equals 93, right? So we subtract 91 from both sides. Oops. 93 minus 91. That makes that 0. If I subtract 87 from both sides, that makes that 0. And so then I'm left with X equal to 93 minus 91 minus 87, or negative 85,000. So they paid dividends during the year of $85,000. All right, so then if we look at part B, we have X minus 50 plus 40 equals 90, right? So if I add 50 to both sides, if I subtract 40 from both sides, then I'm left with X equal to, because that becomes 0 and that becomes 0, 90 plus 50 minus 40 is $100,000. Okay. And if we look at letter C, we have, this one's easy, 84,215 less 9,000 less 5,000, right? So there's really no solving for X, you're just doing the math. So that's $70,215 of ending equity, right? All right, and then in letter D, we have 200,000 minus 55 plus X, or what number, equals 100, right? So I subtract 200 and I add 55, and I have 100 minus 200 plus 55. You have to do the same thing to both sides of the equation, right? It's the rule of algebra. I love that class, by the way. All right, so then you have X equal to 100 minus 200 plus 55. So we have net loss in our last year, or last example, of $45,000. Okay, so hopefully you did well on those. Let's see what our next concept is here. Okay, so in this example, they want us to analyze the posting errors from their trial balance. So let me kind of set the stage and remind you where we're at in the process. So the company at this point has posted all of their journal entries to the general journal or to the T accounts, the way that we've been doing it. And so they've computed the balance in each of the T accounts by taking the debits less the credits if it's an asset account or an account that has a normal balance of a debit. If it's an account that has a normal balance of a credit, then they've taken all of the credits less all of the debits and they've computed the balances, right? And so then from there, really, the trial balance, all it is taking each of those accounts and transferring the account name and the balance to the trial balance in a list, right? And when you do that, all of your normal balance of a debit accounts are in the column on the left-hand side. All of your accounts with a normal balance of a credit are in the column on the right-hand side. And you sum all your debits and you sum all of your credits and they should match. Well, what they're telling us is that in A through G, they don't match, and they want us to analyze those errors and identify what accounts are wrong, how much they're wrong by, are they under or overstated. They want us to analyze the difference between the trial balance debit column and the trial balance credit column. What's the difference between the two columns? And then which column is higher, okay? Okay, so in letter A, they tell us that our $3,600 debit to rent expense got posted is only a $1,340 debit. So rent expense is increased by debits, but unfortunately our rent expense was debited for $1,340 when it should have been debited for $3,600. So that means that our debit column from our trial balance is too low by the difference between those two, right? So the difference between the two is $2,260. Our debit column's too low because it should have more debits. So that means our credit column is larger, right, on our trial balance. And then our account that's incorrectly stated is our rent expense, and it's understated by $2,260. Okay. In letter B, we have $6,500 credit to cash, and it was posted twice. So when we're computing the balance of our cash account, our cash T account, we take all of our debits less all of our credits. Well, if we put one too many credits in there, that means our debit balance is going to be too low by that extra credit, right? So $6,500 is our debit column is too low by that amount and therefore less than our credit column. Our account that is misstated is cash, and cash is understated by that $6,500 because we posted one too many credits to it, and credits reduce cash because asset accounts are reduced by credits. Then in letter C, $10,900 debit to the dividend account got debited to common stock instead. So here's what's happened. Our dividend account is increased by debits. It should have a debit balance or a debit of $10,900, and it doesn't. So our debits are too low by $10,900, but our common stock account was debited instead, and our common stock account has a normal balance of a credit, and our credits was reduced by that debit that got posted there erroneously, and therefore our credit column is also understated by $10,000 or too low by $10,900. So our debit column's too low by that, but so is our credit column, so we don't have any difference between the two. Our common stock is misstated and our dividends are misstated, right? So our common stock was debited for that, which means it was reduced because common stock is increased with credits, and therefore our common stock was erroneously reduced and understated by $10,900. And then our dividends should have been $10,900 higher because we were going to debit to increase that, but we hit the wrong account. And so our dividends are also understated by $10,900. In letter D, we had a $2,050 debit to prepaid insurance that got posted as a debit to insurance expense instead. So our prepaid insurance asset account is missing a debit, but our insurance expense account has that debit that it shouldn't have. And so our difference between our debit and credit columns is 0 because we have the debit, it's just in the wrong spot, it's in the wrong account. So we don't have a column that's larger than the other. Our trial balance debits equal our trial balance credits, but we have two accounts that are incorrectly stated. Prepaid insurance is too low. It should have had a debit that it doesn't. And our insurance expense is too high. It has a debit that it shouldn't have. Okay? In Part E, $38,000 debit to machinery got posted as a debit to accounts payable. So here's what's happened here. So we are missing debits of machinery for $38,000. So our debit column is too low by $38,000. And our accounts payable was debited instead. So accounts payable has a normal balance of a credit, but we erroneously reduced that credit balance by a $38,000 debit, because that's how liability accounts are reduced, is with debits. And so although our debit side of our trial balance is too low by 38, our credit side is also too low because we erroneously reduced our accounts payable with a debit, and we shouldn't have. So this one's a 0 as well, because your assets or your total debits will equal your total credits on your trial balance. It's just you hit the wrong account. So our accounts that are misstated are machinery and accounts payable. Machinery is understated by 38,000, and accounts payable is also understated because we debited it to reduce the balance when we shouldn't have. Okay. In part F, $5,850 of a credit to service revenue was accidentally posted as $585. And so the difference between those two numbers is the amount of credits that we're missing from our total on our trial balance, which is making our debit column higher now. And then our incorrectly stated accounts is just going to be our service revenue. And our service revenue is going to be understated by that $5,265 because we posted a credit of $585, which increases our revenues, but we should have posted $5,850. Okay. All right, and then in letter G, we had $1,390 debit to store supplies that never got posted. So we're missing $1,390 from our debit total on our trial balance, which means our credit column's higher. We have incorrectly stated store supply asset account, and it's understated. We didn't post that debit, so our balance didn't get increased. Okay? All right, so here's the exact same problem, different numbers. Why don't you take a stab at it, see how far you can get, and then when you think you're as far as you will get, you can resume the recording and we'll go through the answers. Okay, so $4,300 debit to rent expense got posted as a $1,360 debit. So our rent expense should have been higher, meaning our total debits and our trial balance should have been higher by the difference between the two. So if our debit total on our trial balance should have been higher, that means our credit column is currently higher. Our rent expense is understated by $2,940. So in part B, we had a $5,800 credit to cash that got posted twice. So we erroneously reduced our cash balance. So we're missing a $5,800 debit or number in our debit total on our trial balance, which means our credit column is higher. Our cash is misstated. And because credits reduce cash and we posted an extra credit to cash, that means our cash is understated by $5,800. So in part C, $12,000 debit to dividends was debited to common stock instead. So we're missing $12,000 in our total debits on our trial balance. But our common stock account is in the credit column because credits increase common stock and it has a normal balance of a credit, so therefore it goes into the credit column of our trial balance. But it was erroneously debited by that $12,000. So our debits are missing a $12,000 total, and our credit side is also too low by 12,000. So we don't have a difference between our columns, but we do have misstated accounts. Common stock is understated by 12,000 because we debited it erroneously, reducing its balance. And our dividends are understated by 12 because we should have debited it, and dividends are increased by debits. Okay? In letter D, $3,100 debit to prepaid insurance was posted as insurance expense instead. So we're missing a debit in prepaid insurance, but we have an extra debit in insurance expense, and therefore our total columns aren't going to be any different. But we have misstated prepaid insurance and misstated insurance expense. So prepaid insurance is an asset, and to increase assets, we debit, but we never did. It got booked to the wrong account. So that means that we're understated by $3,100. And then our insurance expense, we increase expense by debits, and the insurance expense got a debit that they shouldn't have gotten. So they're overstated by $3,100. And then in Part E, we have a $20,000 debit to machinery that got posted as a debit to accounts payable instead. So we're missing a debit in our machinery asset account, but we reduced the liability, which is in the credit column on your trial balance, that we shouldn't have reduced. And so therefore we don't have any difference between the columns, but machinery and accounts payable are misstated, right? So we're missing our machinery asset of 20,000, so it's understated by 20. And accounts payable, we reduced with that debit of 20,000 that we shouldn't have reduced. So our accounts payable is also understated. And then in F, we have a $9,500 credit to service revenue that was posted as $950 instead. So revenue is increased by credits, but the problem is we only credited $950 and we should have credited $9,500. So the difference between the two is what we're off. We're missing $8,550 out of our credit total on our trial balance, which means our debits are higher. Our account that's misstated is service revenue and it's understated, right? And then in letter G, we have a $1,900 debit to store supplies that just never got posted. So we're missing that $1,900 out of our debit total on our trial balance, which means our credit column is higher. Our store supply asset account is incorrectly stated, and it's understated because debits increase that account and we're missing that debit. Okay, so this is probably one of the more challenging pieces, both of this presentation and just in the chapter in general. So it might be something you want to listen to once or twice or 3 or 10 times until you can wrap your head around it. And as always, if you have questions, you feel free to reach out to me. All right, I think we have one more. Let's look at one more, and it's a different way to look at these, at analyzing posting errors. Okay. Okay, so analyzing errors again, here's another example that we're going to look at and work through in a little bit of a different manner. So we're told that the columns in a trial balance don't equal. And after careful analysis, we discovered that a journal entry to purchase an automobile was correctly recorded, but it just got posted erroneously. And so they're asking us to answer each of the following questions about this error. And we're going to look at it and answer it by using T accounts. Okay, so they tell us that the journal entry for automobiles, we debited automobiles and we credited accounts payable, right? And so when we post that journal entry to our T accounts, our debit comes down to the automobile T account to the left side because that's where debits go. Our accounts payable credit goes to the right side of accounts payable because that's where credits go, right? And if we know that our ending balance is $37,100 in our automobiles account, and we have a correctly journalized debit of $18,950, that means our beginning balance is $18,150, right? You just back into that, $37,100 minus $18,950. And then they tell us that our beginning balance in our accounts payable account was $55,000, but that relates to all other items, so nothing to do with our error or the current transaction. It's just the beginning balance, let's call it. So that means that our ending balance in our accounts payable account should have been $73,950, right? But here's what happened. So our automobiles, nothing changed, right? That all got recorded correctly. But our accounts payable, rather than posting this $18,950 credit to the correct side of the T account, we posted it to the incorrect side, right? Wrong. And so what's happened is our ending balance in our accounts payable is $36,050 when it should be $73,950. And so here's their questions. Is the debit column of our trial balance overstated, understated, or correctly stated? Well, here's the debit side of our trial balance, right? Related to this transaction. Nothing's changed. That one's correct. Is the debit column is the credit column of our trial balance overstated, understated, or correctly stated? Well, here's what it is. Let me find my pointer. Hang on a second. All right, here's what our balance is. Here's what it should be. So that means our credits are understated, right? By the difference between the two, $37,900. Is the automobiles account balance overstated, understated, or correctly stated? I don't know. I don't see a difference here. Do you? Yeah, it's correctly stated. And then is the accounts payable balance overstated, understated, or correctly stated? It's understated, right? By the $37,900. And then if the debit column total of the trial balance is $200,000 before correcting the error, what's the total of the credit column before correcting the error? So if our total debits in our trial balance is 200, and in letter B here, we say that our credit column is understated by $37,900, then that must mean that 200,000 minus $37,900, $162,100 is the total of our credit column. Okay. All right, so this is the exact same example. Why don't you try to work through that using the T accounts on your own? And then when you think you're finished and/or you are stuck, feel free to resume the recording and we can go through the answers. Okay, so we know that our journal entry was recorded, right? Because they told us that. Okay, so when we bought our automobile on credit, we debited automobiles and we credited accounts payable. So what should have happened is when those got posted to the general ledger, automobiles should have been posted to the left side of our T account. Accounts payable should have been posted to the right side of our T account. If we have an ending balance of 57,000 in automobiles and we have a debit of 20, then our beginning balance must have been 37, right? Back into that. And then they tell us that our beginning balance on accounts payable was 55,000 plus our 20,000 credit means our ending balance is at $75,000. But what happened, nothing was incorrect about the way the automobiles were posted. But accounts payable, when we posted that $20,000 credit, we posted it to the wrong side of our T account. We posted it here and it should have been over here, right? So what's happened is 55,000 less 20,000 gives us a balance of 35. And so our balance of 35 with the error should have been 75 if it was done correctly, because we erroneously reduced this by 20,000, right? Should have been 75. So is the debit column of our trial balance over or understated or correctly stated? Well, the debit balance in our automobiles account should have been 57, and it is 57. So we must not have a difference or a problem with our debit column. So the answer to that is correctly stated. And B is the credit column total of the trial balance under or over or correctly stated. Well, we have a credit balance currently in our trial balance of 35,000, but we should have a credit balance of 75. So that means it's understated by 40, right? Is the automobiles account balance overstated, understated, or correctly stated? Everything's fine with our automobiles, right? Right, and letter D is the accounts payable account over, under, or correctly stated. We already said it's 35 and it should be 75, right? Correct, or it's understated by 40,000. If the debit column of the trial balance is 260 before correcting the error, what's the total of the credit column before correcting the error? So we said that the credit column was understated by 40. So 260,000 minus 40 is $220,000. Okay, so that's it for the exercise problems for chapter 2. As you're working through the homework, if you encounter any issues or problems, please don't hesitate to reach out. But I'm hoping that with all of the information in this PowerPoint slide, you are armed and ready to go. Take care.